I think from a kind of taking a step back from a macro industry perspective, you have the Work Number, who's really been the only one of the few institutional grade solutions in the past. They charge an absolute fortune for a service that's pretty darn simple, especially when they're getting most of their data from ADP. That old model has really had a tremendous amount of stress over the last couple of years for good reason.
Welcome to Seeking the Truth, where we explore how successful companies and business leaders use data to make confident decisions. Hosted by Kirill, CEO and founder of Truth, a one-stop solution for income and employment verification.
Okay, Jeremy, thanks for joining Seeking the Truth. Really nice to have you. I'm going to introduce you. Tell me if I messed anything up. How does that sound?
Sounds great.
All right. So you're partner at nyca today, but you had a long career in credit. So you know everything about how to underwrite and then sell loans. You started your career back in, back as an analyst at the company that is no longer around, which is called Lehman Brothers. You were then at Deutsche. And then you switched to the startups where I guess you were director of capital markets at Social Finance, SoFi Today, Lending Club. And then right before you became a VC, you were at a firm doing everything underwriting and managing the capital markets.
Yes, and finance.
And
everything
finance.
Everything that you need me to
do. Awesome. Tell me a little bit about your career heights.
So I think a few things. One is, so you actually missed one thing that you could gloss over, but like after I spent 4 years on Wall Street at the beginning of my career, I ended up going to Uganda to work for a microfinance bank. And most people thought I was crazy, including my parents. But it actually taught me, it's the reason why I got into fintech, because here I was in the middle of Uganda, trying to figure out how to take that business model, expand it throughout East Africa, and to a population that hadn't had traditional financial services, and there were operational efficiencies that allowed for that to happen that weren't actually occurring in the U.S. So when I came back stateside, and right at the time when Lehman Brothers was failing, I realized that the lessons I learned in Uganda in terms of technology were going to come to the U.S. in a big way, and that's why I shifted from the Wall Street path, and not that I enjoyed it that much, but I learned a lot, and then came to the startup world. I'd say in startups, I think as every entrepreneur and knows that you have your ups and downs, and so it kind of vacillates between we're going to the moon and we're fucked, and everything in between, especially in the early days. So you have to have a thick skin for that. But I really enjoyed that process, especially at SoFi and a firm where we started to rapidly scale, figure out the markets and see the results from that.
That's great. I skimmed over the Uganda experience. How did you even end up going to Uganda?
So I studied economic development in college, and I had an interest actually in going to Latin America. But what happened is I was at Deutsche Bank, and in their philanthropic arm, they lend to microfinance banks. So I started volunteering for that group. And I said, hey, this seems kind of fun. I'm sick of my, Deutsche Bank job. Can you, hook me up with someone in Colombia or Peru or, Argentina, Brazil, wherever it would be. And they said, no, don't have anything there, but we do have something in Uganda if you want to go there. And I'd never been to Uganda. I honestly could pinpoint it on a map. I hadn't seen Last King of Scotland yet, so I didn't know about Idi Amin. But I ended up meeting the CEO of this microfinance bank, who was actually an American guy, and he co-founded it with a Ugandan gentleman, and so really liked them and what they were building, and just took the shot and moved to Kampala.
That's an awesome story. I like how you switch from banking to Uganda and to fintechs. That's pretty incredible story.
Well, if you can do business in Uganda, you can do it anywhere in startup land. It's just not that hard compared to doing business in East Africa.
That's incredible. For people who'll be listening, what's the biggest learning or lesson that you want to share with people who'll be listening?
In terms of career path, so I would say whatever job you take, don't think that you're planning for 20 years in the future. Figure out what skills you want to build over the next 2 to 3 years, and how that role will help you, build up those skills. And those are the types of jobs you should take. Not necessarily what you think you want to do in 20 years, because no one knows what they want to do in 20 years. So you have to kind of build up step by step, and find where you can thrive. In whatever organization you join.
Great. Okay, I guess we're going to talk about underwriting. So I'll just shoot the questions. What's missing from the underwriting today?
Well, it's interesting. So in traditional consumer underwriting, I think we're at a point where FICO scores have never been valid for the broader population. But now there's broad realization that they're even less effective, especially, I think, post '08. It's important to note that credit has been somewhat discouraged. And so there's been a generation that's come into the system who, unlike their parents, decides to, transact on debit cards versus credit cards. And so, or delays buying a home, or delays buying a car. And so they're somewhat like credit invisible in our current system. And so, at NYCA, we've been very focused on ways to better disseminate credit through better data. And some bureau data is very valid and useful. But there's also a lot of data about individuals and their behaviors that are outside of bureaus today. So that could be bank account transactional data and payroll. So like you go to the source, a consumer's money comes from work, right? And so if you can tap into work, you understand a lot about that individual, how long he or she's been working at that job, the progression of income, the volatility of that income, and that can help assess creditworthiness, quite a bit. And I think that's been missing from general credit assessments over the years.
Okay, so now you have this new sources of data. How does that change the underwriting process? If you start from like the very beginning all the way to the end, kind of should you be looking at this data? What are the common pitfalls?
Well, I think there's two sides of this. One is, how do you optimize your funnel? If you're a lender, how do you make sure that you get as many people through as possible? So traditionally, you don't want to put them through like KBA, knowledge-based authentication, because 5 questions about what was your mother's maiden name, or what color house was next to yours and where you grew up. These are very difficult questions that sometimes the mother's maiden name you should know, but the rest are tough. So I think the application flow has to be somewhat streamlined, and so you want to ask the potential borrower minimal questions and things that they know to get them through the funnel, and so that's the emphasis that you typically put on. But if people for whatever reason don't qualify, or you don't have enough information through that process, then you go deeper and deeper and deeper into the consumer's credit profile. by asking for additional data sources. And I think that's become, worthwhile for consumers to go through, and much more trustworthy. Like, the first Plaid-oriented integrations, like no one wanted to put that in their info. And now I think it's become commonplace. And we're seeing that in payroll as well, where, payroll is much less threatening, I would say, than a bank account, because you think, oh, I give my routing and checking number, can someone steal my money? And the answer is no. But in the U.S., there's a stigma against this. With payroll, there's not much someone can do with username and password, and it brings very useful information saying, hey, like, I actually do make money. You should trust me, and this is the way I prove it. So I think it's a very effective tool to not shake out the funnel too much, but bring more people in to conversion.
In terms of like the talking about conversion, how did the funnel change since the COVID hit in the last couple of years? We've been moving more and more online. It's less offline process. What happened in terms of the conversion and how you should be thinking about the funnel?
Well, there are much fewer paper applications now, and you sit in a fintech startup, you're like, why is there paper at all? But the reality was, whether it be in auto or mortgage, is still a mess. Just a ton of paper, and so I think it's been a great boon for the fintech industry to say, hey, we've got a solution for this. I know, bank, you were reluctant to actually use this, but your customers are ready. No one can go into the branch today, and we've got tools that can manage your risk tolerance and bring in quality loan applicants. So digital applications also can break down the challenges associated with just people not being available during working hours and such, and so it really does widen the general population that can apply for credit, and also just streamlines that process overall.
So if the process is streamlined, everything is digital, I guess it's also set up for fraudsters, right? Because you don't need to show up, you don't need to present yourself. How do you think about fraud in this digital environment?
So fraud is, I would say, probably the least understood part of consumer credit, and in small business credit as well. You saw rampant fraud in PPP, and I think it's going to take us years to figure out the full extent of that. On the consumer side, I think fraud is probably the most important tool that out there to actually fine tune your credit funnel. So at a firm, there's multiple ways to actually, like, you're not just assessing someone for credit. The first thing is, Kirill just came to apply for a loan. Is this really Kirill? And if it is Kirill, then it's like, okay, then we can underwrite Kirill as an individual and decide whether he's creditworthy. But if you say, I'm going to assess Kirill's credit, and then I guess I'll double check and make sure Kirill is Kirill, there's a lot more risk in that process. So fraud should be front and center of any credit process, especially when you're going online, fully digital, fast application, instant delivery. Is the critical component to developing strong credit models.
So talking about credit models, so it used to be just FICO, right? Let's just run FICO, get the FICO. How do you think about the credit models now? So more inputs, more types of data. How do you even test the model? How do you think about the model that makes sense for your business?
Well, I think it's a daunting task at first to create a credit model. Lenders have been developing their models over years and years. I think the problem on the the traditional finance side is that's a linear regression model that takes months, if not a year, to update, and that's just not a dynamic way of looking at a large population. On the fintech side, I think the modeling techniques have been proven to work quite effectively, and not that like there are sophisticated banks that are using ML models and know how to implement them correctly. So, I think if you take the average community bank, they don't have the resources to get a data scientist to actually build that for them. Capital One is pretty darn good at it. But X bank, like my hometown bank, probably is not using ML models. On the fintech side, I think there's a lot of talk about throw FICO out the window. I think that's really overblown because everyone's using bureau files. The difference is FICO has its inherent biases in it. And if you have the raw data that makes that FICO, you can come up with your own score if you think you can do better. So, what most modern lenders are doing are taking data attributes associated with FICO, developing those into signals, and then testing those signals versus, you can back test them versus, populations that you've approved in the past or declined in the past, and try to see what's most effective. But it's taking the bureau files, it's taking bank account transaction data, it's taking payroll data, it's taking context. So did a borrower? My favorite thing in the personal loan space is, did the lead come from Credit Karma? Did it come from direct mail, or did it come from someone Googling "I need money now"? And just based off of the sourcing of the applicant, like there's it's highly predictive that the person who's Googling "I need money now" is going to be a worse borrower with equivalent FICO scores than someone who comes in from Credit Karma or direct mail.
So how would you think about those channels then? So is it just because of the fraud or the intent, or why one channel would be different than the other when you run a scoring model?
It's behavioral. So at a firm, we found out very quickly, fencible goods were higher credit risk than non-fencible goods. So you sell someone a beautiful sofa or a mattress, that's less risky than DJ equipment, or electric skateboards were a tough one for a while. You figure out these patterns, but literally, and there's brand association too in buy now pay later. So there are premium brands, and then there are not so premium brands, and for equivalent bureau data, you're going to get different outcomes depending on who's attracted to that brand and why. So that's just so you can have an attribute associated with that brand. You can have a higher cutoff depending on how you're thinking about risk as well. But source is a really interesting behavioral characteristic. And there are plenty of other ways to assess behavioral characteristics. Like you have the folks like Zest who pioneered how are you moving your mouse? How fast do you type? Do you misspell words and things like that? I've been kind of less interested in that and more interested on fast and generally accurate decisioning and not getting that last 0.1% of approvals.
Okay, so the world went from everybody has a car, credit card, house, building the credit file. That's kind of how you get better terms. Now, there's more variety. Some folks just don't have credit file at all, more debit card usage. What do you think is going to happen in the next few years? Let's say 3 to 5 years. How will the market change?
Well, I think digital offerings are going to continue to proliferate. I think in general, consumer finance will continue to be a fragmented space. So the dreams of the financial supermarket or the like credit card that solves all problems, like it's everyone's trying to do it. I don't know. Maybe there will be one or two breakout products, but there's not going to be eight, kind of centralized solutions to consumer credit issues. So you're going to continue to have fragmentation, lots of custom solutions depending on what type of credit is needed. For auto loans as more cars move online, used cars move online, different type of there's a full range of housing finance now, whether it be traditional mortgages, HELOCs, but also on just non-traditional ownership structures, and so that's going to and by that I mean type of lease to own oriented setups or other designs. Folks like Divvy and Landis are in that bucket. And on the consumer side, for large dollar, even small dollar purchases, if the credit's available at checkout, that's going to continue to be an effective tool to solve that specific problem. And I think consumers like when they say, I financed this couch versus I have $1,000 balance on my credit card.
So let's now shift gears. So now you decided that Kirill is good, like you want to give him a loan. What do you do with the loan in the background?
What do we do with the loan? Well, so the loan is onboarded into the servicing system, right? And so servicing is an incredibly underrated or under focused area of like how loans succeed, right? And so you have a lot of so at nyca we've invested in businesses that actually help on the servicing side. The Peach Finance, which was founded by Eddie Osashur, who is my colleague at a firm. He built our servicing system. He built a Nova servicing system, and now he does it as a service, and so he's very good at it. But having a fully flexible platform on the back end is super important. So if you want to offer a different loan type that traditionally doesn't fit into the traditional models, that's critical, as well as digital means of communication. The overall servicing experience, consumers expect not only readily available information, but also the ability to get answers on any questions they have very efficiently. And so through use of chatbots, text communication, email, and really specialized call center technology, I think consumers can have a better and quicker resolution. And it's also just much more efficient for the businesses to run that today.
So you were talking about servicing, but also I wanted to understand what happens in terms of capital markets, right? So you send it to a servicing company if you want to keep it on your books. But I guess the majority of lenders today and like fintechs, they actually don't keep it on the books. They try to get it as fast off their books as possible and just be this like origination platform and really like get the loans, underwrite them, and then sell them off. How does that process work?
Yeah, so this is something I've done quite a bit and quite passionate about. And just to kind of say it in a different way, the problem is you have a lending business, you're early stage, and you're like, I don't really want to go and raise money from nyca, hopefully, and just use that to lend out. And like I need leverage on this, or I need to sell this exposure. So I can take the money I get from nyca and I put it into the operations of the business. That's actually a real challenge, because when you start out, you have no track record. And most lenders, if they're good lenders, will say, we really need to see a track record before we're going to lend to you, never mind, just take all the risk ourselves. So there's a bit of a dance that goes on for a couple years, frankly. So it's not an easy process, but the challenge is, how do you use kind of near-term financing to be able to demonstrate that you know what you're doing, and then the next step is you go and say, okay, like I raise a few $1,000,000 from friends and family to go and demonstrate that my product works. Then I'm going to take it to X lender and say, look, I did this 6 months, no defaults, or maybe that would be too tight of underwriting, but so here's a data set. Here's how I'm actually building up the business. Here's where I think it's going, and you at least have something to show. So that's when you get your, call it, first real credit relationship, and that's often like very difficult to sell still, in terms of like offloading all the risk. So you often do need some degree of equity capital supporting, call it a lending facility. But then you build up a bigger book, show more track record, and then then there are real conversations to be had in terms of scale and capital efficiency. We're going to major banks, getting larger, more efficient and cost-effective facilities, selling that risk to counterparties. And my biggest thing here is, you never the folks that will finance your loans will say, bring everything here, we'll take care of it for you, don't worry about anyone else. That's actually the worst thing you can do, because you've got all your eggs in one basket. And so you always want to have a distributed capital strategy where you have multiple counterparties. And obviously you can't start off with 5. You start off with 1, but you want to diversify your capital sources to make sure that if one shuts down for whatever reason beyond your control, like, you've got other trusted partners. And I think that's the real secret to capital strategy is, don't put all your eggs in one basket, diversify risk, find partners that you trust, make sure that you've got true alignment. And that's, that enables you to focus more on how can you develop the best, lending products for your customer base, versus, versus being focused on where's that next dollar of lending capital coming from.
How does it change over time? So let's say you're just starting out and you're on the block, and who would you sell it to first? And let's say 5 years in and you're somebody like a firm, how would you think about getting the loans off your books?
So it's quite a different strategy. So you have, in the early days, so there are a number of credit funds that are out there that will either buy risk or lend at very high advance rates against that risk. It's not cheap. It's not cheap at all. They charge very high rates, and they should, because there's a lot of risk involved. The issue is that you want to graduate from them eventually, and they know that. But they also want you to be engaged with them for as long as possible, because they're doing a lot of work up front. And you want, you're being a partner to them. And so they don't want you to run away, and you want to support them as well. But from there, it's you go from, call it, credit specific funds. Hedge funds start playing in at, once you think you can produce $50, $100 million worth of exposure for someone. As you start getting bigger, you look at securitization. Securitization is a process that's not for the light of heart. One thing that people don't realize is, okay, so when you're in an early stage startup, you do the best you can. You always have data issues. It's really hard to reconcile to the penny. When you start getting into sophisticated capital markets relationships, you need to tie to the penny. You need to figure out how to do that. You need to build systems that help ensure that you're able to tie to the penny and know where every dollar, every loan is at every moment of time, right? And that's a big project because nothing is built in its terminal state up front. I can say that with surety. So, but as you're approaching securitization, there are banks that will help you with that process. And securitization is really just a public financing. So, and the reason why you need to spend so much time on the data side and compliance side is because everything has to be buttoned up. So if you have a warehouse line from good friends at Morgan Stanley or JP Morgan or Goldman or whatever it is, and you're like, oh shit, there's a bug in our system. They're not going to be happy, but they can work through that process with you to reconcile everything and get everything on, good to go, and you move forward from that. If you find a bug in your system, with an active public securitization, it's a real problem. It's kind of like, not to go into crypto land, but if you have a smart contract's kind of dumb in that, like, there's always corner scenarios that aren't thought about, and so if you have a smart contract that triggers, it's like, oh, this thing collapsed. That's the last thing that you want it to do. Versus if you have a lending relationship, it's like, okay, this is a problem. Let's work through this together. As long as everyone's working in good faith, you can come up with a good solution. So securitization, you got to be locked in. You got to have great confidence that your data is accurate, that you can continue to do that, that your underwriting is going to continue to be at the standards that are dictated by that financing. And what that allows you to do is access a lot of major investors who are looking for that mature product and are willing to make a lot less money because it's a mature product rated by a rating agency and supported by the major banks of the world in terms of underwriting.
I like how passionately you talk about securitization and capital markets. I'm sure you have some stories. Anything crazy that happened that comes to mind? I don't know if you can go into details.
Well, I not with securitization. I'll give one story, and I will remove names to protect the guilty. But in a past company, we were refinancing out a facility at some point, and we're basically refinancing out the previous facility, and we were pledging to a new facility, and it was a lot of loans, and it had to be done same day, because if you don't do it same day, like, you have to come up with the cash to support all these loans unlevered. So, let's just say you've got $100 million worth of loans, and your advance rate is 80%. Then you have $20 million against those $100 million worth of loans. But if you all of a sudden intraday need the other $80 million, like, you're kind of bankrupt. And so no one wants this scenario to happen. Of course, we, with the entity we were refinancing from, everything was fine. There are no problems. The new lender, almost, we kind of, you trigger something. It's like dominoes. You start a process and you can't really stop it. And so we started that process. The new lender came to us at around noon Pacific, so that's 3 Eastern, and there's a wire deadline of technically it's 4 Eastern, but it can be pushed quite a bit. It's however long someone stays, and clears your wire at the Fed, and usually they want to go home when they're supposed to go home. So anyway, the new bank comes and says, hey, we're missing all this documentation. In fact, this entity isn't set up correctly. And so we have our lawyers scrambling to fix that as quickly as possible. It ends up being a 2-page document. We look it over for 30 seconds, we send it off, and then we're just waiting finally, so it's 1 o'clock, it's 1:30, it's 2. We're like, what's going on here? And then like finally at like 2:25, they say, okay, we're good to go, and you can release your wire. And so we hit the wire, and 5:30 is like, so 2:25 Pacific is 5:25. 5:30 is the hard deadline where the wire is just shut off. And so we send the wire, and we're just waiting to see if it clears. Like no one can guarantee that it clears. And we're all in the conference. There's no Zoom back then, so we're all on a Polycom with the bank, and we're like, so guys, like, are we closed? Dead silence. 2:30, 2:35, 2:37. They're like, just kidding, we're clear, we're good. and the deal is done. We didn't go bankrupt that day, which is nice. But it was way more stress than we wanted to be. It was in the early days of the business. I would not do it like that today, but we got through it.
As you were talking about it, I had like my hands started sweating. Because I can imagine like sitting in that conference room, like, and the time is ticking, and you just, did it clear or not? Who knows?
Yeah, we were opening the faux champagne after that one.
All right. Well, you're investor in truth, so thank you. I really enjoy working with you, and highly recommend to all the entrepreneurs who will be listening to this that Jeremy and nyca are great partners. I guess you've been looking at this space for a little while. Why did you decide to invest in the space, and why did you decide to invest in truth specifically?
I think a few reasons. One, I think in general, so I've said a few times during this conversation that payroll data is very important and very powerful. So I believe in that. I think from a kind of taking a step back from a macro industry perspective, you have the Work Number, who's really been the only one of the few institutional grade solutions in the past. They charge an absolute fortune for a service that's pretty darn simple, especially when they're getting most of their data from ADP. That old model has really had a tremendous amount of stress over the last couple of years for good reason. And every bureau wants to be in this business. Every consumer underwriter wants this information, but it's got to be cost effective, and it's got to be efficient for the potential borrower to relay this information in a secure and safe way. So, there's been very active participation in the space, and the question is, who can actually build technology solutions that take very difficult technology problems and simplify it on the consumer side and deliver the business proposition in a very cost-effective manner. And so with our surveying of the space and talking to all the major folks, true was our answer. Kirill, you and team, you've assembled an exceptional team. So truly a product and engineering led organization, which is paramount to anything that I would want to invest in. And I think you understand the game quite well, that you've got traditional financial institutions that would use this data a lot more, given a different approach. And so you've done an exceptional job of helping them realize that. And there's many more to convince. So, bank and non-bank lenders, I think this will become table stakes, just like pulling a bureau file will be over the coming years. And it doesn't have to cost $40 a pull like the Work Number has in the past. And then on the fintech side, offering solid solutions there, especially point solutions that help lenders assess income and the complexity around income is very, very important for modern lending. And so I think Truth's platform approach really solves both of those kind of legacy and ongoing future problems quite effectively. So it's been it was great on coming to this decision and to be lucky enough to be part of the company. But it's been even more fun as we've started to work together with some terrific partnerships that will benefit you hopefully over the long run.
That's great. I'm excited to partner and see where this whole market ends up in the next couple of years. Whenever somebody joins Truth, we have this tradition where we ask for 2 truths and a lie. Do you have yours?
Here are my 2 truths and a lie. Truth number 1, I've been infected by multiple parasites over the course of my life and gotten rid of them. Truth number 2, I was on the winning Little 500 cycling team at Indiana University. Truth number 3, I grew up in Southern Indiana on the Kentucky border, and everyone I grew up with had a Southern accent except for me.
Awesome. Thanks for coming. It's been a pleasure.
Thank you for having me.
Thank you for listening to Seeking the Truth. You can keep up with the latest on our podcast at truth.com/podcast or wherever you get your pods. We'll see you next time.